Good morning, everyone. Thank you for joining us today. Excited to kick off our HiNotes for the month of August. We have Paul Ray with us from Anders CPA and Advisors, and he will get started momentarily. My name is Erin Kopek, and I'm the VP of Sales and Marketing with Higher Level. And today you have joined our program talking about crucial information to get to the other side of interest rates and inflation. So thank you for joining us on your morning today. So a few housekeeping items before we get started. Our call will be listen-only mode, so you will not have access to speak during the presentation. However, I do encourage you to ask questions, and Paul will take care of those at the end of the presentation. You can use that messaging function in your GoToWebinar toolbox, and that will help you send us messages throughout the presentation to be able to take care of that at the end today. The call we're looking at lasting, it'll be less than an hour, so short and sweet, great information to get your day started. So a few information about Paul before he kicks us off here. So Paul is the Director of Strategic Growth with Anders CPA and Advisors. Paul brings 33 years of experience in the banking and finance industry, specifically working with private wealth management, commercial and industrial banking, and commercial real estate and investment management. His experience offers a focused view of the overall financial picture for Anders clients. Paul is a member of the firm's CARES Act research and response team and advises clients around the latest legislation of COVID-19 relief, including the Paycheck Protection Program. In his advisory role, Paul provides strategies for growing industry groups and identifies new opportunities for clients and of the firm. His expertise in overall asset management, credit assessment, and reviews is beneficial to uncovering needs and financial opportunities for the firm's business clients. We appreciate you, Paul, joining us this morning, and I pass it off to you.
Well, thanks, Erin. I want to thank everyone for joining today. These are certainly unprecedented times, and we just love our partnership with Higher Level, and we appreciate them allowing us time to visit with you today. And really, we just hope you pick up a couple things today that may help you think about the direction you want to move as we kind of navigate our way through this. Right after COVID kind of became a thing back in March of 2020, we were hearing all about these stimulus packages that were going to come our way. We were hearing about something called the CARES Act, and all of you as business owners, and I know we've got a couple, I sneaked a peek at the attendance list, and we got a couple bankers out there, so I always have to make sure I'm cautious there. Banks did a great job and helped navigating through this. I think we got a couple educators, and I'm not an economist, so if you are, you're not going to get detailed solutions today. As you know, that will take hours. So what we hope today is just give you kind of a little background and some things to look forward to. Remember the CARES Act? It popped out. What do we do with it? And as you as business owners, which most of you are on the phone, the day-to-day operations. What does this mean? What are we going to do? Are we going to have to shut our business down? There was so much uncertainty. And, here we are 2.5 years later, and we kind of forget all that. That was a trying time. One of our senior partners stopped by late one evening and said, hey, I don't know if you know much about this SBA, this CARES Act. We got the pandemic going on, and we felt like we're doing a lot of great things. But do you think our clients are going to have trouble navigating this thing? And think they're going to need our help? And I think my response at the time was, yeah, the federal government has taken the largest stimulus package by many times in our history, and we've put it in the hands of the smallest, most inefficient at the time organization within the federal government, which was the Small Business Administration. Well, obviously, the IRS came in later with some of the other tax credit things, but we all remember that PPP, that Paycheck Protection Program, was the thing that's going to help us launch and move our way through. I think the challenges with all of this is if you're a CFO, a business owner, a finance manager of a company, and you have less than 17 to 18 years of experience, you haven't experienced interest rate fluctuations like we're going through now. None of us really have, but you really haven't experienced a quote rising rate environment. So you haven't had to look at that balance sheet and worry about where those interest rates are going to go and what they're doing. It's fun to talk about it, but things move pretty slowly. We have had a unprecedented smooth ride for 15 to 18 years in interest rates. So let's kind of move down just a little bit here, and I'm controlling the slides, and there's a little delay. So if it takes a moment, give me just a second here. Aaron, for some reason, the slide's not wanting to advance. Any idea why? Let's try this.
Yeah, I see your mouse moving. Let me look and see and make sure your controller is still good to go.
Well, we always know there's one thing for certain, uncertainty. So
yeah, try it one more time. I do see your mouse moving. It might just be.
Mouse is moving, but it's not controlling the slides in any way, shape, or form.
Do you want to try your mouse if you're using your keyboard and see if that works?
We can try that. Our
So
practice, it worked fine. There we go.
There we go.
Maybe there is just a little bit of a delay here and it popped it right back. So really the first few slides we have, I thought maybe we could smile just a little bit, because we're probably not going to smile too much as we go on through the rest of the day. But when you think about getting funds poured into us, individuals, companies, all those types of things, and we felt like we saw a way through this. I think the thug around the corner, inflation, everybody used transitory terms, those types of things, but we found out it's here to stay. And I think we all felt like, especially in this business, that it could cause a problem pumping this kind of money. Think about it: individual stimulus checks, PPP, EIDL loans, ERTC, restaurant revitalization funds, shuttered venue grants. They just kept coming. But what happened is, a year plus later, some uninvited guests came, and certainly inflation was one of them. So let's see if we can move past that pretty quickly here. There we go. So the next really was just kind of a play on rates. So we're going to talk about that today a little bit. So the Fed, they can raise rates and they can lower them as well, and they really do that. They raise them to control certain things like inflation, but when we get to a certain point, then they have to lower them. The odd thing about the whole thing is they will actually go down. We talk about gas. Gas gets up to $5 a gallon, and then now it's decreased. We're seeing, under 4. We're seeing some in the mid 3s, and we kind of are comfortable with that. And we realize that, yeah, it can go down more, but it's never going to get to where my parents paid for gas at $49.9, those types of things. Well, interest rates can. I mean, if you look at it, my parents, in 1971, the interest rate on their house was 16.3%, and they were happy to have that. I paid 7.5% for my first loan back in the, I think it was early 90s. My son and daughter both in the past 5 years have paid under 3%. So interest rates can go up and they can go down just as quickly. But when food rises, all of those other things some of that rise sticks. And that's what bothers us about that. But the Fed obviously can control these rates, and they can get back down lower than we've seen in history again. So we don't want to make snap decisions or judgments. So let's see if we can get to the last one here. There we go. And I apologize to my banker friends on the phone here, but you kind of feel this as individuals. They want to apply for a loan, not for a mortgage, auto, education, but for groceries and gas. So, that's a reality. And we need to make sure that as we're moving forward, paying attention to inflation and interest rates are something that we're going to have to do as business owners more than we've ever done before. And we certainly want you to partner with people that are used to doing these types of things, and your advisors, because the next 2 to 3 years are going to be pretty critical for your business. So apologize, got a little bit of hay fever going on today. You already know a little bit about me. Banking is the background. Clearly, I've looked at for 40 years the balance sheets and income statements of companies, directed them in which direction to go from a strategic standpoint, and we'll continue to do that as a firm as well. So, looks like we finally got the slides going well. So let's talk about what inflation really is. We hear it every single day, and as I said earlier, it takes us all day long to talk about it. But let's set just a little bit of a background here. We keep hearing about Nobel laureate economists and how they think inflation is going to reduce quickly, or it's not going to reduce quickly. We hear all of these different economists and their views, and what we realize is that no one really knows where this thing is going. We feel like every day we get news that maybe it is starting to pop down. Then the next day we get some more news and maybe it's starting to pop up. But no one can fully agree. So let's just take it down to the business level. You as business owners, what does it really mean to you? Things cost more. I mean, that's just simply put. And if you try to understand the economy and the economics of how everything works, it would drive you nuts. But you got to run your business every day. So we just know things cost more. So what do we do? Do we reduce inventory? Do we cut costs? Do we cut marketing? Do we cut entertainment? Do we cut salaries? All of those things. Pardon me. And some of those we may want to do. But the real key is inflation causes us to make decisions, and we have to do it to keep our business moving forward. But are those decisions always the best? And it may just depend on your individual situations. Some companies have a silver lining. They get to now charge more for their product. And if they charge more for the product, that increase may stick a little bit. So eventually that will increase margins. Right now they're just keeping up as business owners, all of you out there. But some of you may be able to let those price increases stick. So an inflationary period, sometimes there's a silver lining. I think some of it is typically short-lived, but when you hear people back and forth, is it really a bad thing? Yeah, we all feel it every day. We feel like it's a bad thing, but there are some silver linings. And one of the things that I kind of want to make sure as we're having a discussion here is that you can't talk about inflation and interest rates without politics creeping in. But we're not going to do that today because, from a perspective of the Democrats, they got plenty to be held for. So do the Republicans. So if you want to be mad, just be mad at all politicians, and that's kind of the way we work through this, because everybody I think shares in a lot of these things. So let me give you kind of my Dairy Queen story, because we talk about reducing quantity and quality. How does inflation, what happens there? Well, we've got to protect profit margins a little bit. So, we talk about silver linings. I'm picking on Dairy Queen. I'm sure they're not on the phone today on the call, but 2 grandsons love to get Dairy Queen. We pop in when the rest of the family's not around. We don't care as much about the health food. And they always ordered a small, I guess it's a Blizzard if I remember right. And about a month ago, we went through and they ordered a small, and it was literally half the size. And the new medium was now the old small. So, they had half the product and couldn't figure it out, and disappointed that, they weren't going to get what they wanted. So, but that's clearly what companies are doing. Take a look at your fast food cups right now. That they literally do fit a little better in your cup holder. Why? The height of the cup probably stays the same. It gives that realization that, hey, it's the same size. But if it's only a quarter of an inch thinner, you think about that times millions and millions of customers. They're protecting their profit margins, and they have to do that during inflation. So these things are out there. We see it every day. Tough decisions have to be made, but typically these tough decisions will benefit you in the long run. So inflation sometimes is a test for a company on how they're going to move forward. And sometimes it pushes them into a comfort zone that they don't like, but 5 years from now they appreciate. Excuse me. It does cause a stain on morale. Both ownership and employees aren't happy about it. We know it's here. We know it's here to stay for a while. We'll talk about that in a moment, but it's not going away tomorrow. So, what do we think about? What do we do? Where do we go next? Well, the next thing we hear about is interest rates. So, why are interest rates in the news? What are we seeing every day? Where are rates going to go? There are literally people betting in Vegas on where rates are going to go. People know in Vegas they love betting on everything, but this is clearly one of the things that it's pretty important to the folks. Let me just kind of move the slide around here a little bit. Pretty important to the folks that are running the businesses every day. So Federal Reserve, they have a primary tool that they control inflation with, and those are rates. And if the inflation is heating up and the economy is heating up, we know what's going to happen. Rates are going to rise. And we thought about this 3-4 years ago, even before the pandemic. We saw that rates were going to start moving up gradually as things economically were getting better and the economy was heating up. And then the pandemic hit and slowed everybody down. But when inflation begins to rear its ugly head a bit, the Fed often just slow walks this a bit and comes up with a plan that they can keep everything even, keep the economy slowing a little bit, but not crashing into the ground, and controlling inflation by raising interest rates. And all of a sudden, this just happened. We realized, it felt like overnight, that finally someone said, "Hey, wait a minute! Inflation is not it's not transitory at this point, and it's starting to hurt people." The inflation measure that the Fed likes to have is at 2%. Well, we're at 9.1% right now, or at least in the month trailing. So where does it go? It may get a little better. It may get a little worse. We don't know. Every day someone has a difference of opinion, one way, shape, or form. So what happens? They start raising interest rates, and it starts affecting the way we look at everything. So July 26th and 27th, Fed had a meeting. They raised it 75 basis points. And that equates to 75 basis points, 0.75%, and increases in most rates that you have. So as an ex-banker, we talk a lot about prime rate as a vehicle that we benchmark everything around. So let's take an example. Before the pandemic, in March of 2020, February, that range, it was prime was at 4.25. After the pandemic was announced, shortly thereafter, the Fed decided we need to drop rates fast. We ended up at 3.25. Here we are, the end of July meeting, and prime is at 5.5%. So it's close to double where it was 2 years ago. So they saw that the economy was still hot. The labor market was still moving forward. So we've got to do something. We've got to cool it off a little bit. And again, remember that 2% number. That's where the Fed would love inflation to be. We're at 9.1. So is it going to drastically drop? No, we probably have a 2 to 3 year period here to think about rates and where they're going, and are they going to drop at some point in time? And they will. And when they do, they can certainly move down quickly. And some people are prognosticating that the end of 2023 will be it for rate increases, and they'll start going down to 24. I think everyone just kind of needs to have a 5-year window in mind as they start thinking about their balance sheet and where interest rates are going, so that if we have something from a geopolitical perspective that changes, it could change inflation all over again, or it could cause the Fed to continue moving rates up. It doesn't take much when we're in a rising rate environment. So when's the next meeting that the Fed gets to do this? Well, September 20th and 21st of this year, they'll do this all over again. So let's say we're prime at 5.5, and they do 100 basis points, which I think that's unprecedented, and I don't think that's where they're headed based on some recent news. But it's pretty easy to determine they're going to do another 0.75%, which we're already into the mid six range before the end of the year. There was a bankers conference about 6 months ago, and the majority of the bankers predicted 5.5 would be where prime would be at the end of the year. Some predicted 6, but that was about as high. I mean, we literally could be close to 7 by the end of the year. And I think most folks know that the interest rates will have to slow down, and next year is kind of anticipated. Maybe they're just a bunch of 0.25% increases, but those add up as well. So I think we need to keep in mind that the next 5 years we should keep that window in mind as we start thinking about rates. Because even if they get up and they stop raising them in 2023, do we think they're going to immediately decrease them? Probably not. We may have a year or two window where they keep them the same or small increases or small decreases. So we don't know. That's why it's important that you think about these things in a shorter term window than we've been thinking for the last many years. So if the rates rise, obviously our borrowing costs do. So does everything else. Houses. Now, we had such a low interest rate environment for so many years that everybody probably that are in a non-jumbo or in mini jumbos are in fixed rates, and they're sitting pretty, but your credit cards aren't. So that affects you as business owners when your customers are seeing their credit card costs go up. Personal loans that are based off of prime and those types of things have increased substantially. Inventory acquisition costs, expansion costs, all those things go up that sometimes you just don't think interest rates have an effect on. They certainly do. So kind of that first thing we think about is, well, wait a minute, rates are, I've been warned and I didn't necessarily believe that it was going to happen, but now that it looks like they're really in this rising environment, should I reduce a bunch of debt? What do I do? Well, that's great to think about, and it's great to sit back and plan to reduce debt. But unless you got a lot of cash, it's hard to reduce debt. That's that first thing on our mind, and it's not a bad thing, but sometimes debt can be your friend. This is that time when you really evaluate how much of a friend it is, but it's certainly out there. SBA products, the 7A product has been a variable rate product for years, very successful because we've been in such a rising or a declining rate environment or low rate environment, but now it's rising. We had conversations with clients 5 years ago that said, you've been writing this variable rate loan for years. You continue to write it as long as rates are down. But if we start seeing rates move in a different direction, there are other things that you can do. Certainly SBA, some organizations have fixed rates, some don't. You can get with your bankers. Many times you keep a SBA 7A loan too long. Halfway through it, there are no prepayment penalties on the 7A variables as long as you're careful with the timing. And also, you may qualify for conventional financing. So these are things that now you as a CFO that has a rising rate SBA loan that you've loved for years, maybe it's time to sit back and think about how we move forward. And we'll talk about some of those solutions a little bit later on. So is it realistic? It could be. You can pay off debt like crazy if you got a lot of cash, but most small businesses that I know love to keep the cash for other things. So, so moving forward, what can we do? I mean, that's a simple question that we get from our clients every day. Well, the first thing we tell them, we talked about it years ago, and it didn't seem to bother us then. So we didn't make our moves. So don't panic now. Just stay the course because you're not alone in this. There's all kinds of stats out there, and I'll just kind of shoot a couple to you. But the Department of Commerce says that 74% of all companies have debt, and the pandemic increased that by additional 10. So 84% of all companies have debt of some type. And literally, successful companies have leveraged up a ton over the past 10 years because borrowing costs have been so low. You couldn't go out and find additional sources of capital cheaper than you could borrow it. So all of a sudden, sound companies that were doing extremely well are being pinched a little bit because these costs, if they're in variable rates, and typically, banks don't lend on long-term fixed rates on the commercial side of the ledger, other than some commercial real estate. So most companies have some real interest rate risk in the next couple of years, but seems that everybody has it. So a couple things that we can do. I think, and I kind of put out here a little bit, look short term, look midterm, and look long term. And again, as I said earlier in the presentation, we can't solve this in 35 minutes. So I hope that you reach out to advisors, and we give you a couple clues today that you might think to reach out and ask some folks, does it make sense? Let's get some more in detail. Let's think about things that we've not thought of before. So being creative in that's really important. So what does short term mean? Probably the next 12 to 18 months. And in this environment that we're in, short term, midterm, long term sometimes mean different time periods than it was for many years past. So let's think first about the short term, the next 12 to 18 months. Let's analyze your balance sheet from top to bottom. What does it look like? What are my assets out there? What are my liabilities? And you all know these. You see them every month when you're doing them. But do you really have to dig into them when you didn't worry about interest rates or inflation at all the last 10, 15 years? Now that's become a challenge for you. So analyze that. Take a look at the debt. Is the rising interest rate itself going to cause you an issue if all of a sudden rates double or triple? And if those answers are yes, then there are some things you need to do. You need to strategically think about that debt and what direction we head. So what about my working capital line? I've loved having it. Some banks require you to rest it. Some banks let you have that thing. And I'm going to throw a few numbers out here, and it may apply or apply not. I mean, 200,000 to one company is 2.5 million to another. But let's say your working capital line's 250,000, and you've just always been running that thing and paying interest and never really paying principal down. And banks can be pretty comfortable with that if they've got great clients. But maybe you want to think about taking a chunk of that. On your working capital line, you're going to have to stay in a variable rate. Typically, working capital lines are short-term in nature. But why don't we turn some of that into long-term debt? Why don't you peel some of that off and have a conversation with your banker? I know that rates have been going up, and I'd love to have made a decision earlier, but what about now? Is it too late? Can I take 80% of that and turn that into a 5-year note, fixed rate note, a little higher than it was a few months ago, but this time next year it's going to be a lot higher, and I'll do things differently where I don't have to use that working capital line as much and take advantage of as much, because it was a great place to park your money. It was a low interest rate. So maybe there's a way of looking from a short-term perspective, and I would encourage you to have that conversation with your banker. Permanentizing some of that short-term debt can really make some sense in the short term here. What about midterm? What does that mean? That probably means that 2 to 5 year period. And can I really protect myself from interest rate fluctuations in that area? Things may really be solving itself by the end of that time, but it's a decision that you have to make on things right now. If you're looking at something to purchase and you're going to have that item 5 to 7 years from now, it's probably at its highest point price wise. But if it's something you really need for your business, then look at the financing on that differently than you would in the past. Do I want to short term that somehow? Do I want to longer term that? Or do I really need that piece of equipment? Maybe I can get past that 5-year period. One of the more challenging things that you look at from a long-term perspective is, and that's probably that 7-year plus range. What do I want in that time frame that's different than maybe 10 years ago. Well, that's a tough period of time to think about, because in this environment, it's kind of more short term. But what about that building that's out there that is a building that that you're going to need based on the growth that you're having, but you don't want to pull the trigger on it now. But someone else is going to get it. Well, just because it's the highest at that point in time in the market, you may still need to buy that building. But instead of trying to shop and get that long-term fixed rate, maybe you short-term that thing a little bit. Maybe you even short-term that thing 24 months. Take a 24-month loan that has a balloon at the end of the point, and if rates are still up in 24 months, your banker's happy to refinance it for a year. But we've had this long-term mentality of low fixed rates. Now we're sort of in that piece where we need to be a little cautious about that, and that's why the adjustable rate mortgages are starting to come back. In the 90s, everybody loved those things, but now, or the last 5, 6, 7, 8, 9 years, let's get those 30-year fixed. Well, we're not really in that environment anymore, and especially in commercial real estate. So maybe buying that building is still a sound decision for you, because in 15 years, you're going to need that. And if you don't buy it now, someone else is going to buy it. But think about that financing. Think hard through that financing package. Do things from an alternative perspective. Short-terming that may be the best scenario that you have right now. And as I mentioned earlier, and I think the bankers on the phone would certainly confirm that, is that always happy to refinance. So if you do that short-term, refinance into shorter term intervals if rates are still up. And when rates move down, and they will, you remember 1971, 16, 18%, 5 years ago, 2%. They'll do that again. They'll get there. You just may have to play the game that most of us that did some financing in the 90s had to play. So, keep that in mind. So what do we hear from our clients on a daily basis? We just talked about short term, midterm, long term. So what are we hearing from our clients? We had a bunch of bankers and accountants together about 4 or 5 weeks ago, and we asked these questions. What are your clients thinking about every day? And we know they're trying to run their business. They're having trouble finding employees. They're trying to figure out, to contrast or expand, and these were really the 4 key questions that kept popping up over and over and over again that had some consistency to it. So, should I keep growing? Should I quit growing? Sorry, until rates get better? And maybe digging in is a sound strategy for you. Are you having trouble finding employees? Are you kind of struggling from day to day from a business perspective? Maybe it's a good idea to retrench a little bit. But most of our businesses, we need growth. We realize times like this, historically, we used to call them millionaire makers, and I think that's a pretty easy phrase to use now. Is that now's the time really to latch on. Grab some of the things that are good out there, because this is a short enough term phenomenon that just stopping and not growing may not be the best for you. So, you may be forced to, we talk about idle loans. If you have an idle loan, you're going to be limited to those types of things. And maybe you use some stimulus packages out there that require you not to really move forward and grow and expand. You want to be careful of that. But if you don't have any collars on you, there are banks out there that are willing to loan money. There are venture capital firms, private equity firms that really want to see people continue and move forward. And the SBA is doing a tremendous job at putting new programs out there, because the last thing we need is to stop the growth that we have. So when we hear that question, should we quit growing? We have to be very careful about how we direct our clients. So stop, work with your advisors, make sure that you understand this isn't the end of the road. Should I hold off purchasing the building that I really need for a couple of years? I can't tell you how many times that I've had discussions with clients recently, and you know, buildings right now are as expensive as they've ever been. Rates are up. You can short term the rate, you can get out of the way of that, but you can't really get out of the way of the price of the building. But again, have that 15-year mentality. If that's a building that you need, you have a financing option to do it, you probably don't want to hold off purchasing that building unless financially you just can't do it. And hopefully the bank would be telling you that you can't. So if you have the ability to grow, go ahead and do it. Don't grow for the sake of growing, but be very strategic in what you do. Another, just a basic comment that we hear: should I drastically reduce inventory and pay off some of this debt? And that may be a very good strategy for you right now. I had conversations with a group of bankers and clients a few weeks ago that it's a strategy that's out there. If your price point on the inventory is there, and if you're not particularly selling it, maybe don't pile it on, because that's going to increase from a rate perspective. You're going to have to borrow to get that inventory. So should you reduce it to pay off debt? Often not a sound strategy. You don't want to be selling it out there in the secondary market, but maybe you slow your inventory a bit, and the money that you were going to use to buy that, maybe you pay off some debt. Those are some strategies to think about. But one of the biggest things, and I apologize, I keep drinking water, but this is the time of year for hay fever for me. We don't want my voice to go out. But should I refinance now? If I'm a business owner and I have a loan and I've got a maturity coming up in the next 18 to 24 months, should I get with my banker and refinance now? I think that's a pretty safe yes, and we've worked with a lot of clients on that. Most loans, if they're seasoned a bit, you're probably past the prepayment penalty. So work with your bankers in order to move that forward. We have one scenario with a client right now that, the rates, although they've risen, they were so low, there are still some attractive rates out there. So instead of waiting for his maturity, which was a year from now, he just pulled the trigger and got with his banker and said, I'm going to take a higher rate now, and I'm going to eat that, knowing that when it comes next year, I'm not going to be, a 300 basis point scenario ahead of where I am now. So, he sat down with his banker, they refinanced, he got a little bit higher rate. It wasn't as much as he thought he was going to get, but he put it in a 3-year note, worked well for everyone. In 3 years, I think we're going to have a whole lot better idea of where rates are, a whole lot better that we're going to be in a reducing rate environment again, or a leveling out environment. So saved yourself a lot of pain on a maturity that's coming up a year from now. I know it feels counterintuitive to do that, but be aggressive. Go to your banker, sit down and talk about that. And I think it's certainly a strategy that we're encouraging our clients to look at. And maybe it doesn't work for you, but if it does, take advantage of that. I think at this point, Aaron, I've been going about 40 minutes. I don't really have anything else other than just to, encourage the people that are on the phone that this is somewhat short-lived in the business cycle. So if we're in a 12-month to 18-month, 24-month scenario, we're all going to get through this. We're typically going to get to the other side better off if we work with our advisors, work with the people that we trust every day, bankers, accountants, lawyers. Don't take anything for granted, and still take advantage of programs that are out there. We talk about ERTC as a program. Many of the CARES Act programs are gone. They're finished up. ERTC, the Employee Retention Tax Credit, is out there. It can help you fund your business and offset some of that inflation and interest rates. Not everyone qualifies, but what we found out that many companies, they hear about it, but they just don't have time to think through that process. So get with your advisors on that. It's a great source funding for you that you may be seeking to offset some of this inflation and interest rates. So, Aaron, I'm going to turn it back to you. I don't know if there are any questions or not, but I'm happy to answer them as best I can.
All right, thank you, Paul. Well, I do not see any questions coming in. Definitely appreciate you sharing your expertise with us this morning and giving us some great nuggets on how to move forward with our business in a positive light. So thank you again, and thank you all for attending. We appreciate your time.
Okay, thanks, Aaron. Have a great day, guys.
Have a great day, everybody.